Going over IRS Form 8962, Premium Tax Credit. So this tax credit is available to certain families who participate in the healthcare exchange, receive a Form 1095-A from the exchange, and qualify for a premium tax credit that helps offset the cost of that insurance. So, generally speaking, the tax credit, the intent of the healthcare exchange is that taxpayers with an average annual or household income at that is less than 400% of the federal poverty line should be entitled to a full tax credit on their health insurance. And this is a refundable tax credit. So if you qualify for a premium tax credit, but it's more than your tax liability, you can actually get a tax refund for it. So sometimes people can qualify for what's known as an advance payment of the premium tax credit. So if you get that up front to help offset the cost of insurance throughout the tax year, then you would file IRS Form 8962 to reconcile the amount of the credit that you already took with how much you're entitled to. And then either you break even, you got the exact amount that you were supposed to, you may have been overpaid based on what your income ended up being, in which case you'll have to repay that with your tax return, or you might actually still have some outstanding credit left over because the advance premium tax credit was not enough. And you might actually get an additional or a larger refund than you otherwise would have expected. So this is a 2-page tax form. It's got 5 parts. We'll walk through them just briefly to summarize everything, and then we'll go back and try to tackle this in a little bit more depth. I will say that as a caveat, there is a lot of complexity to completing this form, and most of the time I do videos while walking through the form itself. However, when I was writing this article, I had to pull a lot of tables and worksheets from not only the form instructions, but from IRS publication 974, which is the IRS publication that was specifically created to talk about all the nuances of the premium tax credit. So in this video, we'll go through basic scenarios, but please understand that for anything that is highly complex or considered a long tail topic, we'll probably gently refer back to the form instructions or IRS publication 974. And I will also probably be toggling back and forth between this form and the draft of the article that I'm still completing. So, for example, this is a snapshot of one of the worksheets that we pulled down from IRS publication 974. So we'll just be going back and forth on the parts that don't present themselves on this form. So part 1, you'll calculate the annual and the monthly contribution amount. This is the amount that the IRS expects that you should pay based on your household size and your household income in relation to that federal poverty line. So if your overall household income as a percent is less than 150% of the federal poverty line, then you'll be expected to pay 0 of this contribution amount. If you're over 400%, then you'll be expected to pay your own way, so to speak. And then in the middle, we can do some calculations, and I'll walk you through that scenario. In part 2, we'll calculate the premium tax credit claim and then reconcile that with your advance payment of the premium tax credit. So we'll be pulling information off of Form 1095-A if you have it. In part 3, if you did receive an excess advance payment, we'll walk through this so that you can calculate it. Part 4, specifically is only required if you have to allocate policy amounts. So in the article, we go into a little bit more depth, but probably one of the more common scenarios would be if you got a divorce and you have uh, uh, a policy that covers a dependent, but then so does your ex-spouse, and you both have that person, say a child, that's part of your household, and you have to go through a series of calculations to allocate certain parts of the tax credit based on the monthly amounts. So we'll go through uh, an example of one allocation, and then we'll kind of, uh, you can do this up to 4 times. Lines 30, 31, 32, and 33. And then at the bottom, we'll kind of summarize all of that information. Part 5, we'll briefly discuss it. But if you are claiming the premium tax credit in the year that you got married, you can elect to do an alternative calculation, which may help you qualify for a lower contribution amount. This is an optional field, and if it does not work for your situation and your new spouse's situation, you do not have to use that. So we'll lightly discuss it. We'll talk about some scenarios in which that may apply, and then we'll kind of wrap it up. So let's go to the top of, let's go to part 1, but right before that, you'll notice that there's the taxpayer information and social security number fields. Right above it, there's a box here. So I'll take a moment to discuss this really briefly. So generally speaking, if you're married filing separately, you cannot take the premium tax credit unless you qualify for one of 2 exceptions. The first exception is dependent on you actually living apart from your spouse for the entire tax year, or you're filing a separate return because you meet the requirements for married persons who live apart under head of household status. So you might be technically married, but you're separated, you're getting a divorce. One of you is a head of household under IRS guidance, so that would be an exception. Or you file a single on your Form 1040-NR because you're meeting those exception requirements under Form 1040-NR. Exception 2 is if you are a victim of domestic abuse or spousal abandonment. You can also file a return as married filing separately and take the premium tax credit if all of the following apply. First, you have to be living apart from your spouse at the time that you file your tax return. 2, you have to be unable to file a joint return because you are a victim of either domestic abuse or spousal abandonment. 3, you check this box right here to signify that you are a victim of domestic abuse or spousal abandonment. And then finally, you cannot have done this for 3 years in a row. So you can only do this for up to 3 years in a row, 3 consecutive years. You cannot do it for a 4th consecutive year. So to check this box, you have to be able to say that you are a victim of domestic abuse, and the IRS gives some criteria. So domestic abuse includes physical, psychological, sexual, or emotional abuse, which includes efforts to control, isolate, humiliate, and intimidate, or to undermine the victim's ability to reason independently. All facts and circumstances are considered in determining whether an individual is abused, to include drug and alcohol abuse by the spouse. So depending on the facts and circumstances, abuse of a child or other family member can constitute abuse as well. Spousal abandonment. A taxpayer is considered a victim of spousal abandonment for a tax year if, after all facts and circumstances are accounted for, the taxpayer is unable to locate his or her spouse after reasonable diligence. So if someone just abandons you, that's the definition of spousal abandonment. So check this box if those criteria apply. In part 1, we're going to now calculate the annual and monthly contribution amount. So this is the part that just about all taxpayers file. If you're going to, just about everyone completes this part of the tax form at the very least, if you are going to file this form. So tax family size. Based on the article, you're having to consider specifically whether or not certain individuals lived with you, whether they're filing a tax return. So your tax family generally includes yourself, your spouse, if you're filing a joint return, and your dependents. But if someone can claim you as a tax dependent, or someone can claim one of your household members as a dependent legitimately, then you cannot include that person in this number. So generally speaking, anyone that can be claimed as a dependent can only be claimed by one person, one taxpayer. So you can't claim a dependent for household family or tax family purposes if someone else can claim that person too. So in box 2 or line 2A, we're going to enter modified adjusted gross income. And in the article, we actually break down the instructions on how to do that. For the purpose of this video, we'll just walk through the calculation. So you're going to take your adjusted gross income from line 11 of your Form 1040, 1040 SR, 1040 NR. You're going to add back any tax-exempt interest that you would find on line 2A. You'll enter any amounts that you reported on either line 45 or line 50 of your IRS Form 2555. That's the foreign earned income form. So those are the different, either the housing deduction, the housing exclusion, or the foreign earned income exclusion. We'll add those back in. If you have Social Security benefits where they're taxable. So for if your line 6A is more than line 6B, then you'll subtract the 6B from line 6A and you'll enter the result. And then we're going to combine all of those numbers, and that'll be your modified adjusted gross income. Now, since in line 2B, we're going to enter your dependents modified adjusted gross income, here's a note specifically for people who file IRS Form 8814, which is the election for parents to report certain children's passive income on their tax return. I paraphrase that. That's not the exact name. But if you have a child with dividend and interest income and you choose to put that on your tax return so that they don't have to file, that form is IRS Form 8814. You may need to go back and if line 4 of that Form 8814 is greater than $1,250, then you may have to do another worksheet calculation where you will take that amount and add that under line 2B. So we do cover that a little bit more in depth in the form instructions. For this purpose, we're simply illustrating the fact that you may or may not need to do that. In line 2B, we're going to calculate the modified adjusted gross income for your dependents, walking through the identical steps that we just talked about. However, we will also include that that information for your any of the undeclared or the reported dividend and interest income for your children. However, this should only be for dependents who are required to file an income tax return because they meet the income tax return threshold requirements. So in line 3, we're going to combine those items. We get $52,000. In line 4, we're going to pull one of the amounts from the the appropriate table of the federal poverty line. So we'll go to our article and we're going to walk through this really quickly just so that you can see exactly what we're talking about. So we have table 1-1. Most taxpayers will use this. It's the federal poverty line for the 48 contiguous states and the District of Columbia. Table 1-2 is specifically for Alaska, and table 1-3 is for Hawaii. So as you can see, this is the number, $32,470. That correlates to this table 1-1, with a family at $50,000 or $52,000 and a family of five. A family of five living in the lower 48. This is the number that appears. So now we have to convert the household income as a percentage of the poverty line. And according to the form instructions, you basically divide the line 3 amount by the line 4 amount, and then you multiply that result by 100. And in this case, we get 160%, which means that the Doe family, their income is at 160% of the federal poverty line, which is well below the 400% threshold to qualify for any tax credit. However, it's above the 150% threshold that absolves you of any contribution amount. So they're in the middle, and we have to figure out what the applicable figure is. So fortunately, the IRS gives us an applicable figure table. So this is the calculation you can go through, or you can just do what I outlined. You come up with the same result. The applicable figure, however, comes from a table that's prescribed in the IRS instructions. So for a 160, you can see that the figure is 0.004. And again, less than 150, you would just put 0 there. 400 or more, you would put 0.085. So you would still have a decent amount of responsibility left. So we put that amount right here, 0.004. Yep. And when we multiply line 3 by line 7, we come out with $208. And then we divide that by 12 and we come up with $17 per month. So that's what the federal government expects the Doe family to contribute from their household income based on their family size and their modified AGI. So in part 2, we're going to walk through this calculation, but before we do that, what I want to kind of indicate is that you'll see a pretty dizzying array of lines here. So you can either do an annual calculation if you qualify, or you may have to break down your monthly calculation. And so we'll walk through the annual amount, and then we'll kind of talk through what you may have to do if it's under certain circumstances on a monthly basis. So for line 9, if you are allocating policy amounts with another taxpayer, or if you want to use the alternative calculation for the year of marriage, then you would actually skip this part for now, and then you would either go to part 4 or part 5. We will walk through hypothetical scenarios of each of those parts, but for the purpose of this calculation, we're simply going to move forward in this form. Now, according to the instructions, there are certain criteria that will determine whether or not you can use the annual amounts and basically just walk through line 11, or if you have to actually break down the monthly amounts. So, so the form instructions basically indicate that that if you had full year coverage and there were no changes reported on your IRS Form 1095A, either column A or column B. So basically, your Form 1095A kind of looks like this. And as long as there's no change to your monthly enrollment premiums or the second lowest cost silver plan premium, as long as that remained the same for all of these columns, then you can simply use the annualized amount. Now, if there's different figures in here reported, like a different figure for February than from May, that's when you're going to have to break this down into monthly amounts. So for the purpose of this demonstration, we're going to walk through, but then we'll also see that really all of the monthly calculations is just taking different information and having to report it appropriately in 12 different rows instead of one. So for this scenario, we don't have John Doe's actual 1095A completed. However, it did say $4,800. The second lowest, the second lowest cost silver premium was $3,600, and then the annual contribution amount from line 8A is $208. So we subtract the $208 from column B, which is the second lowest amount, and that's the total maximum premium assistance available. So the $3,392. So the actual credit that was allowed is the smaller of either the $3,392 or A. So if you ended up paying that $400 a month, the IRS expected you to pay the $208, but realistically, the difference between that second lowest cost and the $4,800, that $1,200, that's also a taxpayer responsibility. You're only going to get the credit for this $3,392, which would have covered this amount with this backed out. So basically, they're saying that your responsibility is whatever the cost for the second lowest silver plan, or whatever the cost of the second lowest silver plan minus your annual contribution amount. That's what the government's going to subsidize. Everything else is your responsibility. And then the annual advance, in this case, they got $3,000. So since column F is less than column E, you can safely assume that they're going to get a tax credit back. So we'll just put in some numbers. Let's just say that January kind of played out the way it is out here. So in this case, the monthly assistance amount would be $283. The monthly tax credit would be that. But let's just say in June something changed. They changed their plan, or something happened, and they found a plan that was a little bit less. This is a completely different scenario. So So you can see that even though, the premium changed here, the rest of this kind of stayed the same. Now if something different was reported to you for this, the annual applicable or the monthly applicable second lowest cost silver plan, then that might adjust some of these changes. But, unless the actual premium cost dip down below this number, in this case, we would take the smaller of column A or column D. That's the only thing that would change is if column A became less than column D as a result. So, but if for some reason columns A and columns B are different on your Form 1095, or if you complete part 4 and things are different, or if you got married and you have to do part 5 where you calculate the alternative calculation, then most taxpayers are probably going to be able to annualize everything. If nothing significant changed, then you probably do line 11. What you won't do is both. So if you're doing line 11, you can skip all of these. And if you're doing lines 12 through 23, you can skip line 11. So for the time being, we're going to use the numbers that are in the annual form. So I'm just deleting those. So we bring down the 3392 from column E, and then we bring down the $3,000 from column F. If we're completing lines 12 through 23, we would have to sum all of these up, and then you would enter the totals into line 24 and 25. And then in line 26, we basically subtract the difference, $392. We would report that on Schedule 3, which is the tax schedule for additional credits and tax payments, or tax credits and additional payments. Line 9 is where the premium tax credit goes if there's any above and beyond that advance payment. So in part 3, we're actually going to pretend that this 392 is a negative. So we're actually going to just flip these numbers to make them easier. And this is what you would do if this is the difference. First, you would leave this blank. So if they equal each other, you would enter 0. But if they don't, you would leave this blank, and then you would enter the difference down here. So 392. And then there's what's called a repayment limitation. So basically, the IRS is saying, okay, you might need to repay some of your excess. Hold on a second. Not so fast. Let's see if you can qualify for us to maybe forgive some of that amount. So basically, we are going to use this table, Table 5 from the form instructions, to indicate how much we should enter on line 28. So since it's a married couple, and John Doe is not single, he's got a pretty big family, line 5 amount happens to be less than $200. So the repayment limitation for his family is $700. So let's go back to the repayment limitation. So now we'll enter the smaller of either line 27 or line 28 here. And that happens to be $392. So let's maybe go back and see, what would have needed to happen. So let's just say that our annual premiums were like $6,000. And then this basically gives us a total hold on. Let's imagine that we got $4,000 back. Yeah, $4,000 as an advance premium tax payment. But we were only entitled to $3,000, so this amount would be $1,000, right? That's the difference. But because of their tax filing status back in line 5, the household income as a percentage of the federal poverty line, the IRS is going to say, hey, you only owe $700. We're going to give you a break. And then we would put the $700 as an additional tax on Schedule 2, line 2. Okay, so if you have to put anything into Part 3, that amount is going to go onto Schedule 2 because you're paying back a tax. If you're putting a positive number in line 26, you're going to actually put that figure on Schedule 3, which counts as a tax credit or an additional tax payment. So depending on where you fall, you could either be, getting extra money or paying extra money, after you reconcile. So in part 4, we're going to basically kind of walk through, what this would look like. So if you had an allocation, and so probably the best way to describe that would be if we kind of walked through the uh, allocation rules. So you need to be able to allocate policy amounts based on, if your health plan has an individual within your family, but then also someone else that's not in your family, or if someone might be able to claim, or receive a Form 1095A for someone that's in your family. So, Table 3 in the form instructions has basically situations in which you would determine certain, the rules of allocation. So step 1, if you got divorced or legally separated and the policy covered at least one person in your family and one person in the other family, then you would walk through allocation situation 1 in the form instructions. Uh, if you were married but you're filing a separate return and it covered an individual in your family and the other family, you would use situation 2. If no one paid, or if there was no advanced premium tax credit, then you would use situation 3. And the form instructions, and then there's another situation 4 for kind of everything else. Now, we don't go into this in that depth in the form instructions because the in our article, it's already a 5,000 word article. So if you need this, you would have to go straight to the form instructions. So we're just going to kind of outline this, again, not out of respect to any of those allocation specific instructions. We're just kind of walking through this. So if you did have to allocate, you would end up with a policy number. You would put in the social security number of the other taxpayer, and then when the allocation started and when it stopped. So 01 for the month of the year. If it lasted the whole year, you would put the 12th or 12 for December. And then let's just say everything was split down the middle. You would put 50%, 50%, and then 50%. Or whatever was actually, based on those allocation rules. So you can do that with up to 4 policies. And if you need more than 4, then you're going to have to basically put the rest of the information. You're going to have to attach a memo to your tax return with allocation directions for the 5th and subsequent allocations. But if you have completed all of them and it only took 4, then you can multiply the amounts on your Form 1095A. You would multiply them by policy, and then you would add all of those numbers up, and then you would use that information to complete lines 12 through 23. So have fun with all of that math. In part 5, again, this is an alternative calculation for the year of marriage, and there are additional rules that you can use. So this, you would have to answer a table of 5 questions, again in the form instructions. So if you end up answering yes to all of these questions, then you can use alternative calculation. Were you each unmarried at the beginning of the year? Were you married at the end of the year? Are you filing a joint return? Was anyone else in your tax family enrolled in a qualified health plan before your first full month of marriage? And then did anyone receive advanced premium tax credit during the tax year? So if you didn't, or if you say no to any of those, then you're not eligible to elect the alternative calculation. So in the alternative calculation, basically you'll walk through additional instructions that are, we'll go to part 5 and we'll kind of walk through what this looks like. So If you did not answer yes to all of those questions in Table 4, you could still go through the worksheet that is in the form instructions to determine if you received excess advance premium tax credit. So if you did receive yet that, then basically you can use the alternative calculation to determine whether or not you might get a lower contribution amount, right? So, and then you would walk through worksheet 1 for yourself. That kind of discusses your alternative family size, forces you through a different set of calculations, and then you're going to enter specific information from that worksheet. Worksheet 1, line 1 goes into column A. So column A would be worksheet 1, line 1. The alternative monthly contribution amount comes from line 7, I believe. Then line 7, 8, and 9 all go through here. So line 1 from table 1, line 7, line 8, line 9. And then for your spouse, you have to do the same thing, but there's a separate worksheet called worksheet 3. Your spouse's alternative monthly contribution amount. And you basically go through the same steps and you enter the same information just using worksheet 3. So we put a hypothetical alternative family size here, alternative monthly contribution amount based on worksheet 1, alternative start month, stop month. So again, you don't have to use part 5 even if you got married in that tax year. You can only use part 5 if you got married during that tax year. So that's all we have. And again, the net result of this, you're either going to have a number that you put on Schedule 2, which means that you owe a repayment of the advance premium tax credit, or you're going to have a number that you put into Schedule 3, which means you actually get to claim the premium tax credit or an additional amount of the premium tax credit that was not covered by that advance payment. So we break this down in as much detail as we physically can in our article, which you can find on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8962, and you should see the article. If you need additional guidance, we did put links to the form instructions as well as IRS Publication 974 throughout the entire article. So please pay attention and hop in and out as you need to. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there's a tax topic that you'd like to see discussed in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.